Hello everybody, my name is Lesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. As an investor, one of the things you want to determine is what types of stock investments you like. So for myself, I've divided stocks into 4 general groups, and this is how I think of them. I differentiate the stocks based on what their quote unquote primary financial ratio is. So I'll explain. So the 4 categories are stocks with number 1, a price to earnings ratio in a reasonable range. Number 2, a price to cash flow ratio but no PE. Number 3, a price to sales ratio but no PE. And finally, no sales at all. And this also is the sequence of my preference for those stocks. So starting with number 1, the stock has a reasonable price to earnings or PE ratio. The PE is in single digits to around 30. The company makes a profit, which means the company won't go bankrupt, and it can pay a dividend if it wants to. So an example would be financials like TD or Sun Life. And it is a typical value investment and something that I would favor as a solid, boring stock. That just keeps paying dividends. Number 2, the primary ratio is the price to cash flow ratio for the stock. This stock has a price to earnings that is huge or non-existent, meaning you're paying a lot for $1 of profits or there is no profit. The stock has a free cash flow from the sales after paying its cash costs. Stock has sales but either large expenses, so it barely has a profit, or it just has losses. Or it has managed to do its accounting in such a way as to invest via capital expenditures back into the company, but make it an expense on the income statement rather than an asset on the balance sheet. The company value is increasing and it pays no taxes. And Amazon is a perfect example. They did this for years. They had a giant PE, but the company was growing because they were reinvesting the cash flow back into the company. Now, another example in this category would be a utility company with lots of assets which are depreciating, but on paper only. This lowers its profits possibly to zero or even a loss, but the company has lots of cash flows because there's no actual money leaving the company. All of the assets are depreciated on paper and usually quite quickly in order to take advantage of the expenses to lower the profits and to pay less or no taxes. But the company can still pay its dividend because it has a good cash flow. Now, the cash flow can be seen as the most important aspect of a company, making money and not paying taxes. One of the gentlemen in my investing club said that he specifically looks for companies like that and is fine if they make no profits and lots of cash for an extended or indefinite period of time, because the goal of a company is to make money and pay as little taxes as legally possible. These types of companies could be value investments because of the dividends, or a growth company which is expensive in terms of the PE, and there's lots of expectations of even more cash flows in the future. The third category is companies that have a price to sales as their main ratio. So these are your stereotypical growth companies. They have lots of sales, perhaps increasing sales, but no or very little free cash flow after its expenses have been paid, and definitely no profits. These are growth companies with lots of expectations of cash flows in the future because there's really no cash flows today. Sales can be seen as a good approximation of a company because the sales can't be manipulated in the same way that profits can. For example, some companies, to make their profits look good, will cut research and development, which makes the next couple of quarters look good on the bottom line, but costs the company in the long run. Sales are organic, so they can be seen as a good indicator of a company's health. So if you prefer these somewhat speculative companies which don't make a profit today, you would be using the price to sales ratio as your primary indicator. And finally, we have companies with no sales and obviously no profits, just expenses and constant losses. So an example would be a company like Nikola, which is an electric trucking company, which has just a business plan and nothing else. They don't have a truck, they don't have the hydrogen distribution network, and they don't have the electric charging network either. Or you could look at a Canadian junior miner who has yet to find whatever mineral or metal they are looking for. So they again are just burning through cash, and they have no profits and no sales. Or you could even think of this category as being a junior pharmaceutical company that has yet to get its drug approved and is making no money at this point. There is some small overlap possible between these four categories, but I prefer to think of them as mutually exclusive. I usually try to go for the first two, and I'll think really hard about the third, and I will ignore the fourth. I hope you found my classification of stocks according to their primary financial ratios interesting. Uh, and it's how I think of the investing world. But obviously, you have to form your own opinion and view of the world. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.